Welcome back with me, Melissa Ong. The UN Trade and Development expects weaker growth in 2026 as slower global activity, rising debt, higher trade costs and persistent uncertainty weigh on performance. Now, joining us to discuss the outlook is Professor Dr. Peter Meyer, Adjunct Professor of International Economics at Faculty of Business and Accounting, University Polytech Malaysia and Osnabrück University of Applied Sciences, Germany. Prof, thanks for taking your time to be with us. Happy New Year to you. Now, looking back, 2025 was a turbulent year for global trade. How does 2026 compare to 2025 in terms of risk and opportunities for global trade, Prof?
Thanks for having me. It's still very difficult for us to learn how to deal with the new challenges of new policies pursued by the United States, policies by Russia, by China. So economists all over the world are confronted with the challenge of actually finding models to base their predictions on. So at the moment, the uncertainty is still very high. It's still very difficult to predict. We have to be honest in accepting that some of our predictions last year proved wrong. We assumed last year at that time that the economy would develop very differently. So I think from our perspective, the uncertainty remains high. The opportunities, however, for countries and for companies, they are there. So there will be a redirection of trade. There will be a restructuring of relationships. There will be new alliances. So I would say there is no reason to be completely negative on the next year or so. From our perspective, from my perspective, it's still we can expect actually positive growth of output and of international trade.
Now, it's great that you have a positive outlook, Prof. Now, the US has maintained high tariffs, with Bloomberg calling 2025 the year of tariff and predicting this year, 2026, will be the year of consequences. Now, how are these tariffs likely to perhaps reshape global trade patterns and also supply chains?
The reshaping is taking place. So in terms of exports, in terms of direct investment. When I look at Germany, where I am at the moment, we look at, for example, investment in Malaysia, we look at investment in Vietnam, we look at investment in India, we look at new possibilities in Africa. So the reshaping takes place, and it will continue to take place. And in a way that's a normal process. At the same time, some of the relationships, they are really the result of long-term planning of complicated supply chains within companies. 1/3 of international trade is trade between companies which belong together. So let's say Siemens Germany is exporting to Siemens India, or General Electric United States is exporting to General Electric's Chile. So 1/3 of international trade is between firms which belong to the same conglomerate. And that signals that some of these structures, they are really the result of long-term planning, of very smart maneuvering in terms of where are the labor costs lowest, where are the resources available. So I would say that such structures take a long time to be readjusted. So some part of international trade is actually is not going to change in the short time. in the short term, but other parts, the consumer-oriented exports from China, they will, for example, they will be redirected away from the United States, for example, to your country, or at the moment to Europe. We are at the moment trying to figure out how the European Union should respond. For example, steel is one of the big issues where China is now redirecting their exports to the European Union, and we try to sort of decide should we allow this international trade to happen. If it's long term, it's beneficial for us. If it's only short term, it might destroy our industry, and in the long run, we are ending up being dependent. So one of the big issues of what we learned from the last years is that we need to have more resilient economies. And resilience means we have to diversify. We have to diversify our supply chain structures. We have to diversify the countries from where we source our products. So the main lesson, I would say, of last year's turbulence is go for resilience. But this is a complicated challenge because it's involving reactions by the government, and it involves reactions by the corporate players.
Right. I'd like to ask, why has there been a minimal impact on markets from the US attack on Venezuela, including ASEAN markets, such as Malaysia included? What are the long-term implications, especially for the oil market? There are fears of a glut, and if more oil starts flowing from Venezuela, which would surely impact OPEC, would it? Your thoughts on this, Prof?
Yes. In the long term, there will be definitely an increase of supply, and so in the long term we can expect a reduction of the oil prices. In the short term, I don't see that. I mean, we were all shocked. I think the world community did not really see that Venezuela has 20% of the oil reserves, they say. 20%. This is huge. This is incredibly high. And at the same time, 1% of the total production at the moment. And when we see how this nationalization of the oil production in Venezuela, what kind of impact it had on the Venezuelan economy and on the total, on the market for oil, it is incredible to see this decline in this country. So once that the plants in Venezuela are restructured and are up to the standard, then there will be a substantial increase of the supply, and that will definitely have an impact on prices. That will lower the prices of oil.
Well, Prof, definitely a lot to talk about, especially on global trade, and we would like to invite you to our show once again, perhaps the next time. But thank you for your time and for helping us better understand the challenges and opportunities shaping a global trade this year. We'll speak with you again soon. Thank you.
Thanks for having me.
Now stick around, I'll return shortly with more global updates. This is The World on Bernama TV.